Imagine standing on a dock at dawn. In front of you sits a wooden ship, freshly tarred, its sails furled, its hull creaking softly against the pier. The cargo has already been loaded. Bales of wool, barrels of wine, chests of spices, perhaps silver locked in iron-bound crates. Investors are watching. The crew is waiting. The tide is turning. Now imagine this. Once that ship slips beyond the horizon, almost everything that matters is out of your hands. If you strip away the romance that later centuries attached to pirates, storms, and distant oceans, the basic problem early merchants faced was plain enough. A ship was expensive. The cargo inside it was often worth more than the ship. The voyage might take months, and once the shoreline fell behind, almost everything that could go wrong was outside any one person's control. Weather, hidden reefs, fire, disease, war, seizure by an enemy state, capture by privateers sailing with official commissions, or robbery by crews and raiding parties who had no commission at all. Long-distance sea trade could generate enormous profits, but it could also produce sudden, total ruin. What marine insurance did over a long and uneven historical arc was turn that uncertainty into something that could be written down, negotiated, priced, and enforced. It did not remove danger from the sea. It did something quieter and in some ways more revolutionary. It created a paperwork machine, a system that allowed merchants to move risk around, split it into pieces, assign it a price, and decide which dangers were worth taking and which were not. To see why that mattered, it helps to begin not with insurance itself, but with older tools that merchant communities used to manage maritime loss before anything like a modern policy existed. One of the most durable ideas in maritime trade was that sometimes a loss had to be intentionally caused to save the whole venture, and that when this happened, the people who benefited should share the cost. If a ship was in distress and cargo had to be thrown overboard to lighten it, the owner of the sacrificed cargo was not supposed to bear the entire loss alone. The principle appears in ancient and Roman legal traditions associated with the lex rodia, and is reflected in Roman compilations such as Justinian's Digest, and it became a foundation for what later law called general average, a shared contribution toward a deliberate sacrifice made for the common safety. General average is not insurance in the later sense. It does not pay out when a ship simply sinks. It does not protect a merchant from the financial consequences of a bad voyage as a whole. But it shows something important about maritime commerce very early on. The sea created losses that were both common and socially negotiable, and merchant communities built systems to distribute those losses rather than leaving them to whoever suffered them first. The later history of marine insurance, when it arrives clearly in the documentary record, keeps returning to that same theme. Dangerous environments drive people toward shared rules, and shared rules create paperwork. Another older tool was the sea loan, including arrangements later described in terms like bottomry, where money was advanced against a ship, and repayment depended on the ship's safe return. If the ship was lost, the lender might lose the money, and that risk was part of why such loans could carry very high returns. In practice, this kind of credit could function as a way to shift maritime risk through financial terms, but it also sat uncomfortably with religious and legal constraints on usury in medieval Europe. And those constraints helped push merchant societies toward contractual forms that looked less like interest-bearing loans, and more like explicit agreements to indemnify against a specified peril. What emerges in the late medieval Mediterranean is not a single invention moment, but a series of converging habits, written contracts becoming more standardized, merchant courts and civic authorities enforcing commercial rules, notarial practice producing large volumes of consistent documentation, and long-distance trade growing large enough that a single ship loss could be catastrophic even for relatively wealthy families. In the Italian city-states, where notaries, merchants, and financiers worked closely, insurance took recognizable form as a standalone contract, separate from a loan, in which one party promised to compensate another if a voyage suffered a specified kind of loss in exchange for a premium. By the 15th century, and in some cases earlier, historians can point to concrete documentary evidence of marine insurance policies and the clauses that made them work. Research on medieval insurance has highlighted how these contracts define the voyage, the ship, the cargo, the route, the time window, and the specific perils covered. Even the language of medieval policies shows a practical problem being solved. If an insurer promises to cover a voyage, what happens if the ship has already sailed, or if the merchant signing the policy does not yet know whether the vessel has departed safely? Medieval clauses address this kind of information gap by explicitly stating that coverage applied, whether the insured knew it or not. A concept that appears in scholarship on early policies as a way to bind the contract despite uneven knowledge at the moment of signing. That question of uneven knowledge never goes away. It is one of the quiet engines behind insurance's obsession with disclosure, documentation, and rules about what must be said and when. As long as one party might know more than the other about the condition of the ship, the reliability of the captain, the political situation along the route, or the timing of departure, the contract has to decide what happens when the unknown becomes known. Marine insurance, from its earliest forms, is a way to cope with the fact that merchants are buying and selling promises under conditions of partial information. As the contract matured, different ports and trading regions developed their own legal frameworks and commercial practices. In the Western Mediterranean, Barcelona became one of the places where maritime law and insurance practice were strongly articulated, tied into the broader merchant law tradition associated with the Consolat de Mar. References to Barcelona's marine insurance ordinances, dated to the 15th century in later compilations and discussions of maritime law, reflect how civic and mercantile institutions tried to define how insurance should work in practice, not as theory. The details mattered. What perils count as covered losses, how claims are proven, what documents are required, and how disputes are handled. This is where the story begins to look less like an anecdote about daring merchants and more like the growth of a system. Insurance could not become routine unless it was enforceable. Enforceability depended on courts or arbitration mechanisms. Those mechanisms depended on written evidence. Written evidence depended on standardized paperwork, and standardized paperwork depended on specialized professionals. Notaries to draft, brokers to match buyers and sellers of coverage, and later, adjusters and surveyors to measure damage and argue about causation. The logic of underwriting, in its simplest form, is also easier to understand when you put it into ordinary language. Imagine you are a merchant in a port city, and you want to ship a cargo of cloth or grain to another port. You know that if you lose the cargo, you may not be able to repay creditors, pay workers, or finance the next voyage. You want someone else to take on that loss risk in exchange for a fee. The insurer, on the other hand, is willing to take the risk if the fee is high enough, and if the risk is spread across enough separate ventures that a single disaster will not wipe out the insurer. If one wealthy individual insures too many ships traveling through a war zone in the same season, a single naval campaign could destroy that individual. If the same risk is split among many underwriters, each taking a small share, the system becomes more resilient. That splitting of risk is one of the places where marine insurance begins to resemble later financial markets. You do not need a single company to insure a ship. You need a pool of capital and a way to divide a single policy into shares. That logic is visible much later, very famously in London, where the practice of multiple underwriters each signing for a portion of the risk becomes a defining feature of the Lloyd's market. But before London becomes the best-known symbol of marine insurance, it helps to keep a broader map in mind. The reason marine insurance flourished where it did was not because certain cities were uniquely clever, but because certain cities sat at crossroads where trade volume, credit, legal institutions, and information networks were dense enough that contracts could be written, enforced, and resold. The sea was dangerous everywhere. The paperwork cluster grew in places where commerce was already pushing the limits of what informal trust could handle. When marine insurance becomes important in the North Atlantic world, the scale of maritime conflict matters as much as the scale of trade. European states fought long wars that spilled onto the ocean. Governments issued letters of marque authorizing privateers to seize enemy shipping, and prize courts adjudicated the legality of captures. Even when a merchant ship was not destroyed, it might be detained, diverted, searched, or condemned. A voyage that was profitable in peacetime could become a gamble in wartime, and the difference between those two conditions was not a philosophical difference. It showed up in premiums, exclusions, and the fine print of policies. This is where the pirates as paperwork idea becomes concrete. In many periods, the greatest financial threat to merchants was not an isolated pirate attack in the cinematic sense, but a broader environment of raiding and seizure where the line between pirate and state-authorized privateer could blur depending on who wrote the legal record after the fact. Insurance could not eliminate capture, but it could convert capture into a claim category. Once that happens, the question shifts from "will we be attacked?" to "what is the probability of capture on this route this month, and what premium makes that risk worth accepting?" To price that probability, insurers needed information. Information about routes, about which navies were at sea, about which privateers were operating, about seasonal storms and the usual timing of convoys, about which captains were competent or reckless. The more reliable the information, the more confidently a premium could be set. And the more premiums were set, the more insurers wanted even better information, because a small edge in knowledge could be the difference between profit and loss. London's rise in the insurance story is inseparable from London's rise as a commercial and maritime hub, but it is also inseparable from the development of an information marketplace around shipping. In the late 17th century, coffee houses were not just places to drink coffee. They were places where people met to exchange news, negotiate deals, and build informal networks in an age when there was no instant communication. Edward Lloyd's coffee house became especially associated with maritime business, and later institutional histories emphasize that it developed a reputation for reliable shipping intelligence. What does shipping intelligence mean in practical terms? It means lists of ships arriving and departing, cargoes, destinations, and reports about losses, delays, and sightings. That is not just news for curiosity's sake. It is the raw data from which risk pricing can be inferred. If you learn that several ships on a particular route have been taken recently, you might increase the premium for that route. If you learn that a convoy is sailing under naval escort, you might reduce the premium. If you learn that a ship is old, poorly maintained, or badly crewed, you might refuse to insure it or demand a higher price. The point is not that underwriters needed perfect information. They never had it. The point is that insurance turns the value of information into money. In an insurance market, knowing a little more than the next person is not just interesting. It is profitable. That creates an incentive to gather, standardize, publish, and archive maritime news. The printed shipping news associated with Lloyd's becomes part of that system. Lloyd's List, which later sources date to the early 18th century, is presented in institutional histories as a publication that formalized the flow of shipping intelligence that had been circulating informally. And it is tied to the growing underwriting business that gathered around the coffee house network. It is useful to picture how an actual insurance transaction in London could work once this market culture matured. A merchant, or more often a broker acting for the merchant, would bring the details of a voyage, the ship's name, tonnage, master, route, cargo, and the perils to be covered. The broker would approach underwriters who were willing to accept some share of that risk. Each underwriter might take, for example, 5% or 10% of the total exposure, signing their name under the policy for that share. The underwriter would receive a corresponding share of the premium. If the ship arrived safely, the underwriter kept that premium as profit, minus any overhead of running their business. If the ship was lost in a covered peril, the underwriter paid out according to their share. This way of organizing insurance is often described as the hallmark of the Lloyd's market. It is not insurance as a single company's product. It is insurance as a marketplace where many individuals and later syndicates share risks. The paperwork makes it possible. The signatures make it enforceable. The broker connects the parties. The published lists and correspondence make it informable. But underwriting alone was not enough, because marine insurance quickly runs into a hard question. When a loss happens, how do you prove what happened? A ship might vanish. A captain might claim a storm drove the vessel onto rocks, but an insurer might suspect negligence or fraud. Cargo might be damaged by seawater, but it might also have been damaged by poor packing. A vessel might have been captured by an enemy, but was it truly an enemy? And was the voyage lawful under the relevant rules? Every claim becomes an argument about causation and classification. That is why marine insurance grows a dense ecosystem of supporting practices. One of them is surveying, the inspection of ships and cargo to establish condition and value. Another is adjustment, the calculation of what is owed under the terms of a policy, especially when losses are partial and involve shared contributions like general average. Another is salvage. When a wreck is partially recovered, what portion of the value reduces the insurer's payout? Policies and later statutes often contain detailed rules about these issues, because without agreed procedures, the claim process could collapse into endless disputes. These disputes did not just happen in private. They shaped law. By the 18th century, English courts were addressing insurance questions that grew directly out of the problem of information asymmetry and disclosure. One of the most frequently cited cases in this context is Carter v. Boehm in 1766, associated with Lord Mansfield, and the articulation of a duty of utmost good faith in insurance contracts, meaning that the insured must disclose material facts that would influence the insurer's assessment of the risk. The details of the case involve insurance on Fort Marlborough, in what is now Bengkulu on Sumatra, and it became a landmark because it framed insurance as a contract where withholding key information could make the policy voidable. In plain language, the logic is simple. If you are buying insurance and you know something important that the insurer cannot easily know, something that would change the price or even the willingness to insure, you are expected to say so. Insurance markets depend on that rule, because otherwise the people most eager to buy insurance would be the ones who know they are in the worst danger, while the insurer would price as if the danger were average. If that happens repeatedly, insurers either raise premiums dramatically or withdraw from the market. The paperwork is therefore not just documentation. It is a discipline imposed on the exchange of information. The same logic appears in later codification. In the United Kingdom, marine insurance law was codified in the Marine Insurance Act 1906, which sets out definitions and principles that had developed through earlier practice and case law, including the idea of indemnity, insurable interest, and the structure of marine insurance as coverage against marine losses, incident to a marine adventure. Codification does not mean the system suddenly became simple. It means the system had become complex enough and commercially important enough that standardizing the rules was worth doing. It also shows how deeply embedded insurance had become in maritime capitalism by the early 20th century. It was no longer a niche contract used by a handful of merchants in a few ports. It was a core institution supporting shipping, trade finance, and the global movement of goods. To keep the narrative grounded, it helps to follow a single recurring question through time. How does an insurance market turn uncertain events into a price? The answer is that it does so through classification. The market classifies ships, routes, seasons, cargo types, political conditions, and moral hazard. Moral hazard is a later term, but the underlying concern is old. If someone is insured, do they take less care because someone else will pay? Marine insurance contracts and institutions evolved to counter that with requirements, exclusions, warranties, and inspections. Ship classification became part of that. The emergence of organized ship registries and classification societies, including the Society for the Registry of Shipping founded in the 18th century and later associated with Lloyd's Register, reflects a broader push toward standardizing information about vessels, how they were built, maintained, and assessed. This is another way paperwork substitutes for personal familiarity in an expanding market. As trade grows, you cannot personally know every shipowner, every shipbuilder, or every captain. Classification systems and registries are a way to make trust scalable. Even convoy planning can be understood in this same information and classification framework. Convoys are often remembered as a military tactic, but they are also an insurance variable. A ship sailing alone through waters where hostile cruisers operate is one kind of risk. A ship sailing in a convoy escorted by naval vessels is another. Merchants, shipowners, and insurers paid close attention to convoy schedules and naval deployments because those were not abstract strategic matters. They were part of the pricing model. When convoy systems were reliable, they could lower losses and stabilize premiums. When convoy systems broke down, or when navies shifted priorities, premiums could spike. The real work of the system, however, is visible not only in large strategic patterns, but in the routine handling of partial losses and disputes. Consider what happens when cargo arrives damaged by seawater. The merchant wants compensation. The underwriter wants proof that the damage occurred due to a covered peril and not due to poor packing or deliberate exposure. The ship's log, the bills of lading, port records, witness statements, and surveys become crucial. The claim is not resolved by a dramatic confession. It is resolved by assembling documents and convincing an insurer, an adjuster, or a court that the chain of events fits the policy language. In some cases, disputes could turn on highly practical questions that sound almost trivial until you see the money involved. Was a delay caused by adverse winds, or by a captain choosing to stop for trading opportunities? Was cargo spoiled because the voyage took too long, or because it was stowed incorrectly? Did a ship deviate from its declared route? And if so, did that deviation void coverage? The more valuable the cargo and the more common the peril, the more pressure there was to define such questions precisely. This is why marine insurance is so closely linked with the rise of standardized commercial documents. The bill of lading, for example, functioned as a receipt for goods shipped and a document of title, connecting physical cargo to contractual obligations. Charter parties define the terms of hiring a ship. Invoices and manifests itemized cargo. Port clearance documents recorded departures. Over time, insurance policies had to mesh with all of these. Insurance was not a separate universe. It became the binding layer connecting shipping practice to finance. Finance is the next recurring theme, because marine insurance did not operate in isolation from credit. Merchants often borrowed to fund voyages. Lenders cared about whether a cargo was insured, because insurance increased the likelihood that a loan could be repaid even after a loss. In that sense, insurance served as a technology that made credit safer and therefore cheaper, which in turn enabled more trade. The system is circular. More trade creates more risk exposure. More risk exposure creates demand for insurance. More insurance makes trade finance more feasible, and that finance funds more voyages. This circularity is one reason the growth of insurance markets tends to concentrate in major commercial hubs. A city with a dense credit network, lots of shipping, active courts, and reliable news circulation can support a sophisticated insurance market. A small port with occasional voyages can still use insurance, but it is less likely to generate the institutions that standardize and dominate the practice. By the 19th century, as shipping expanded further and industrial production increased the scale and variety of cargoes, insurance became even more specialized. Different lines of coverage developed. Hull insurance for the ship itself, cargo insurance for goods, and later forms addressing liability. Mutual protection and indemnity associations, often known as P&I clubs, eventually became important for covering certain liabilities that traditional marine policies did not always cover well. Even without diving into every later institutional form, the pattern remains consistent. As maritime commerce becomes more complex, insurance creates more paperwork categories to match the complexity. War, again and again, provides the stress test. Wartime risk does not just increase losses, it changes the nature of uncertainty. Routes become politically charged. Neutrality rules become relevant. Blockades and embargoes affect legality. A ship might be seized not because it was attacked at sea, but because it entered a port under a new legal regime. Insurance clauses and premiums respond to that. Underwriters begin to distinguish between marine perils like storms and war risks like capture and seizure, and separate coverage might be required. Here the pirates as paperwork theme becomes particularly sharp. The same physical act, armed men taking a ship, could be treated differently depending on whether they were recognized as belligerents, privateers, or criminals, and the policy language would try to anticipate those classifications. At a human level, it is tempting to think of this as a story about clever merchants inventing new financial tricks, but it is more accurate to see it as a story about scaling trust. A merchant shipping within a small region might rely on personal relationships and reputations. Once trade becomes global, personal reputation is not enough. Merchants need systems that can function when the counterparties are strangers, when the cargo is distant, and when the relevant facts may not be known for months. Marine insurance provided one of the central tools for doing business under those conditions. The underwriter in that environment becomes something like a professional skeptic. The underwriter asks not whether the voyage is noble or adventurous, but whether the probabilities make sense. What is the ship's condition? What is the season? What is the route? What is the cargo? Who is the captain? What is the political situation? The underwriter's business is to convert a messy world into a premium and a set of terms. That conversion always depends on the quality of the paperwork. A policy has to describe the voyage clearly enough that everyone knows what is covered. If the voyage changes, the paperwork has to change. If cargo values change, the paperwork has to reflect that. If new information appears about storms, war, piracy, or blockades, the market responds through new terms and prices. The paperwork is not a dead record. It is the living interface between events and finance. One way to make this feel concrete is to imagine how a single ship loss might ripple through the system in a mature insurance market. A ship fails to arrive. Days become weeks. In the home port, the merchant seeks information. Reports from other vessels, letters from agents, notices in shipping lists. If the ship is confirmed lost, the merchant prepares a claim. The insurer asks for documentation, proof of value, proof of interest, proof the loss occurred within the policy period, proof it was a covered peril. If there is ambiguity, say, rumors of capture versus storm, there may be argument over whether the loss falls under standard marine perils or excluded war risks. If salvage is possible, someone organizes salvage efforts, and the proceeds may reduce the claim. Now add the reality that merchants rarely had only one venture at stake. A merchant might have multiple ships, multiple cargoes, multiple creditors, and multiple insurers. Insurance therefore becomes part of portfolio management long before that phrase exists. Merchants spread risk across voyages. Insurers spread risk across policies. Brokers spread information across the market. And the entire system becomes a web of partial exposures linked by documents. Disputes, inevitably, generate more documents. Courts and arbitration bodies produce opinions and precedents. Market associations produce standardized policy forms. Insurers demand surveys. Surveyors produce reports. Over time, the record-keeping becomes so extensive that the history of marine insurance is also a history of archives. Ledgers, policy books, claims files, registers, and printed lists. In that sense, marine insurance does something that seems almost paradoxical. It is built around unpredictable events, yet it produces some of the most methodical paperwork in commercial history, precisely because unpredictability is what it has to manage. The 18th century London market illustrates this well because its institutional memory has been actively preserved, and because the association with Lloyd's provides a recognizable symbol. Institutional accounts emphasize that the coffee house became a center not only for underwriting but for maritime intelligence, and that publications connected to the Lloyd's name helped formalize the date of flow merchants needed. But it would be a mistake to see London as the origin point. London is a culmination point of several older Mediterranean practices, combined with the scale of British trade and the informational ecosystem of a growing imperial metropolis. The deeper pattern is that wherever maritime commerce grows large enough, a price for risk emerges, and once that price exists, people build institutions to calculate it, argue over it, and enforce it. The idea of pricing risk can sound abstract, so it is worth slowing down and describing the moving parts in a way that remains accurate but approachable. First, there is exposure, the amount of money that will be lost if the ship or cargo is lost. Second, there is probability, the chance of loss which depends on route, season, ship, and political conditions. Third, there is correlation, the chance that many losses will occur at once, as in wartime or hurricane seasons. Fourth, there is information quality, how well anyone can estimate those probabilities. Fifth, there is enforcement, how reliably claims will be paid and fraud controlled. Marine insurance markets develop tools for each of these. Exposure is managed by valuation and limits. Policies define how much is insured. Probability is managed by underwriting judgment, supported by shipping intelligence. Correlation is managed by diversification, not ensuring too many ships exposed to the same concentrated danger. Information quality is improved by record keeping and classification. Enforcement is managed by legal rules, the duty of disclosure, and the threat of litigation or reputational loss in a tight commercial community. When you put those together, the connection between pirates and paperwork becomes very direct. Pirates, privateers, and hostile cruisers are a source of loss events. Paperwork is the mechanism by which those events are converted into predictable financial outcomes. A captured ship becomes not only a tragedy for the crew and a crisis for the merchant, but also in the insurer's files, a coded event. Capture, seizure, detention, condemnation, ransom, or total loss, each with its own implications. The underwriter is not indifferent to suffering, but the underwriter's function in the system is to decide which category the event belongs to and what payment follows. In practical terms, this categorization process also shapes behavior. If insurers refuse to cover certain routes without convoy, merchants pressure authorities to provide convoy. If insurers charge high premiums for ships without certain standards, ship owners invest in improvements or seek classification. If insurers insist on certain documentation practices, merchants adopt them. In this way, insurance becomes not merely reactive but active. It changes the structure of maritime commerce by making some behaviors cheaper and others more expensive. That feedback loop can be subtle, and it is often visible only in aggregate. But it is one reason the history of insurance matters beyond the insurance market itself. Marine insurance helped build a world in which global trade could be financed and expanded, not by removing danger, but by creating a way to live with danger at scale. The codification of marine insurance principles in the early 20th century reflects how mature the system had become. The Marine Insurance Act 1906 lays out in statutory form concepts that had long been negotiated in practice and courts, including definitions of marine insurance as indemnity against marine losses and the need for an insurable interest. The Act does not end disputes. It provides a common framework that reduces some uncertainty about what courts will say when disputes occur. Yet even with codification, the core tensions remain. Insured parties want broad coverage and quick payment. Insurers want precise definitions and protection against fraud and non-disclosure. Merchants want low premiums, especially in dangerous times. Underwriters want premiums high enough to cover losses and produce profit. Brokers want to place coverage efficiently and maintain reputations on both sides. Courts want to apply rules consistently, but they also face changing commercial realities. New ship technologies, new cargo types, new patterns of war and piracy, new geopolitical boundaries, and new data collection methods. All of that sits behind the deceptively simple act of writing down a promise. If your ship is lost in a certain way, I will pay you. That promise, repeated millions of times across centuries, is what allowed merchants to treat maritime catastrophe as a manageable cost of doing business rather than an existential threat. It also helped create new kinds of catastrophes in a different sense. Because once risk can be priced and shifted, people may be willing to send ships into more dangerous waters, to trade in more distant places, and to operate with narrower profit margins, confident that a loss will not end them. The system can enable expansion, but it can also encourage exposure. To keep the narrative anchored in the everyday mechanics, it helps to return to three repeating themes that show up at every stage of this history: information, enforcement, and aggregation. Information is the lifeblood. Without information, underwriters price blindly. Shipping intelligence in coffee houses, correspondence networks, port records, and printed lists is not merely background noise. It is an operational input. The emphasis in institutional histories on Lloyd's coffee house as a center of maritime intelligence, and the later publication of Lloyd's List reflects this practical necessity. Enforcement is the backbone. A policy is only as good as the system that compels payment and punishes deception. Courts and commercial norms shape what counts as acceptable non-disclosure, what counts as fraud, and what evidence is required. The articulation of the duty of utmost good faith in cases like Carter v. Boehm, later echoed in legal discussions of insurance doctrine, reflects how critical disclosure rules were to keeping the market functioning. Aggregation is the scaling mechanism. A single insured voyage is a gamble. Thousands of insured voyages become a portfolio, where the law of large numbers begins to matter, even when underwriters do not speak in those terms. The more voyages are insured, the more past outcomes can inform future pricing, and the more the market can specialize by route, season, and peril type. This is how a volatile world becomes a set of premiums that can be printed on paper. If you pause on that last point, you can see why marine insurance belongs to the history of modern capitalism. It is not just a service. It is a way of treating the future as something that can be bought and sold within limits. It is a method for making long-distance trade legible to lenders and investors. And it is a method for turning violence and weather, two forces that seem inherently resistant to calculation, into contractual categories. That does not mean the calculation was ever perfect. Underwriters were often wrong. Markets could panic. Premiums could spike wildly during crises. Fraud could flourish in certain corners. And there were always losses so large and correlated that they threatened insurers themselves. The system's history is therefore not a story of steady triumph, but of repeated adjustment, new clauses after new kinds of losses, new institutions after old ones prove inadequate, new standards after disasters reveal weaknesses. Even the apparently simple distinction between piracy and war could change over time depending on the political context. In some eras, what merchants feared most were organized raiders in certain seas, such as the Mediterranean, where captives and ransoms were part of long-running conflict systems between states and semi-autonomous maritime powers. In other eras, the dominant threat to shipping came from major state wars that produced privateering and blockade. Insurance had to interpret these threats through policy language. Sometimes separate war risk coverage emerged precisely because ordinary marine policies could not handle the scale and ambiguity of wartime capture and seizure. And then there is the matter of timing, which is one of the least glamorous but most important features of marine insurance. A ship may be lost, but confirmation might take months. During that time, merchants might be insolvent on paper but not in fact. Creditors might demand payment. Families and business partners might argue over whether to declare a loss. Insurance markets developed practices around notices, presumptions, and the handling of missing vessels. This is another reason paperwork expands. The contract has to govern not only what happens, but when it is considered to have happened, and what parties must do during uncertainty. This is also where the insurance market's reliance on published and semi-published information becomes critical. If news of losses is slow, rumor can move premiums. If accurate reports circulate, premiums can be set with more confidence. Shipping intelligence becomes, in effect, a stabilizer of expectations, even when it is incomplete. The goal is not certainty. It is enough shared belief about conditions that contracts can be written and honored. Over time, that shared belief is reinforced by habit. Merchants come to expect that a voyage will be insured. Lenders come to expect proof of coverage. Shipowners come to expect surveys and classifications. Governments come to notice that insurance markets influence maritime activity, and in some contexts, states regulate insurance or rely on it indirectly by shaping the legal environment. If you step back and look at the full arc from medieval ports to modern law, the most striking continuity is not any single institution, but the repeated conversion of peril into procedure. A storm becomes a category. A pirate attack becomes a category. A seizure becomes a category. Each category has a proof standard, a payout rule, a dispute mechanism, and a history of precedents. The romance of the sea fades into forms, signatures, and calculations, not because people lose imagination, but because the money at stake demands a method. In the end, pirates as paperwork is less a metaphor than a description of an administrative transformation. Marine insurance did not defeat pirates. It made piracy legible to finance. It allowed the cost of piracy to be anticipated, priced, and absorbed into commercial planning. In doing so, it helped merchants, lenders, and states expand the scale of maritime trade in a world where violence and weather remained constant companions. And that is why the story of marine insurance cannot be told as a side story to maritime history. It is one of the mechanisms that made global shipping reliable enough in financial terms to sustain the growth of long-distance commerce. The ship still sank. The cargo still vanished. The raids still happened. But on paper, those events began to look less like the end of a business and more like a payable clause in a contract, contingent on signatures made months earlier in a room full of men who were, in their own way, trying to make the ocean predictable. A good way to understand how these mechanisms worked under pressure is to look at what a standard policy actually tried to do. Once marine insurance became routine in London, the market gravitated toward printed forms with familiar wording. One of the most influential was the so-called SG form, associated with Lloyd's from the late 18th century and reproduced much later in the Marine Insurance Act 1906. The enduring importance of that form was not that every ship in the world used it, but that it shows what the market thought a policy needed in order to function. A description of the subject insured, the voyage or adventure, the basic promise of indemnity, and a list of typical maritime perils broad enough to cover real life without being so vague that claims became impossible to judge. Those lists of perils were not poetry. They were an attempt at categorization. A policy had to anticipate storms, grounding, collision, fire, and also human threats, capture, robbery, hostile action. It had to do so without knowing which would actually happen. That meant the policy language was often wide, but the market did not leave the outcome to broad language alone. Over time, it built a second layer of controls, warranties, exclusions, and conditions that narrowed how the wide language would be applied. Warranties in marine insurance are one of the key places where the price of risk becomes enforceable behavior. A warranty is not just a promise. It is a condition that must be strictly complied with. If it is breached, the insurer can often treat itself as discharged from liability from the time of the breach, even if the breach has nothing to do with the eventual loss. That strictness can feel harsh, but it makes sense in the market's logic. Underwriters set premiums based on assumptions, and warranties are how those assumptions are pinned down. If the assumption changes, the underwriter wants an automatic escape hatch rather than a long argument about causation. The classic example is seaworthiness. In marine insurance practice, the idea that a ship must be fit for the voyage is so fundamental that, historically, it could be implied even when not written explicitly, especially for voyage policies. The underwriter is not agreeing to insure a floating wreck. The underwriter is agreeing to insure a vessel that is properly maintained, properly equipped, and properly crewed for the intended route and season. But seaworthiness is not a single measurable thing. It covers hull condition, rigging, pumps, provisions, and more. It also, in practice, touches on competence. A vessel may be physically sound but badly managed. The result is that seaworthiness becomes a frequent background issue in claims disputes, because insurers have an incentive to argue that a loss traces back to an unseaworthy condition, while insured parties have an incentive to argue that the loss was caused by an external peril that would have overwhelmed any reasonable preparation. Another set of warranties concerns route and conduct, where the ship is going, how it gets there, and what it is allowed to do along the way. A policy might be written for a voyage from one named port to another, or from one region to another, sometimes with intermediate stops allowed. If the vessel deviates from the insured voyage without sufficient justification, coverage can be jeopardized. This was not an abstract legal trap. In the age of sail, route choices were often forced by wind and weather, and captains had to make decisions about sheltering in port, waiting out conditions, or taking alternate passages. The law and practice tried to distinguish between reasonable deviation for safety, which a policy might tolerate, and discretionary deviation for profit or convenience, which the underwriter could treat as changing the insured risk without consent. Here the paperwork becomes the decisive battlefield. When a claim is made, the ship's log and related documents become evidence of the voyage's conduct. A log is not merely a diary. It is part of the record by which insurers and courts assess whether the captain acted within the policy's assumptions. So the captain's daily entries, the timing of departures and arrivals, the stated reasons for course changes, and reports of weather and damage all matter. And because all parties know this, the very existence of insurance affects the way records are kept. The log becomes not only a navigation tool, but a future piece of legal evidence. The third major category of conditions involves the political environment, war, neutrality, and capture. This is where the pirate-privateer distinction turns from a story detail into a pricing mechanism. When maritime trade runs through wartime zones, the probability of loss includes not only sinking but detention, seizure, condemnation as prize, or forced diversion. A vessel might be taken by a state warship, by a privateer commissioned by a state, or by a raider who is legally treated as a pirate. From a merchant's perspective, the immediate outcome could look similar. The ship and cargo are gone. From an insurer's perspective, the classification of the taking could determine whether the loss is covered. This is why, in certain periods, insurers introduced clauses that separated marine perils from war risks. The market did this because war risks could be extremely correlated. A single political decision, a declaration of war, or a blockade could affect entire categories of voyages at once. For an insurer, correlated loss is more dangerous than isolated loss because diversification stops working. Even if you insure 100 different ships, if they all face the same war risk, a single campaign can produce a wave of claims. One practical response was to treat some war-related hazards as outside the ordinary policy unless explicitly bought back. Another response was to create special warranties that removed coverage for capture and seizure unless a separate arrangement was made. This produced a more modular system, one premium for the usual hazards of navigation, another premium for war risks. The modularity made underwriting more manageable, but it also meant the paperwork became more complex because the insured party had to be clear about what kind of protection they had actually purchased. Once you introduce capture and seizure into the claims process, the role of prize courts becomes relevant. Prize law exists because, in wartime, States claim the right to capture enemy property at sea, and sometimes also neutral property under certain contested conditions. Captures were not supposed to be simply theft. They were supposed to be adjudicated. Prize courts examined whether a capture was lawful under the relevant rules, including questions of ownership, nationality, contraband, and whether the vessel was running a blockade. For an insurer, a prize court decision could determine whether a loss was final and total, or whether property might be restored. For a merchant, the prize court could mean a long delay in which capital was trapped, and a voyage's commercial purpose was destroyed, even if some value might eventually be recovered. That time dimension is crucial. Insurance is often imagined as a simple transaction. Loss happens, payment follows. In marine insurance, time can be the whole story. A cargo delayed for months may arrive in a technically recoverable state but be commercially ruined. A ship detained may be released but only after expenses that are hard to categorize: port charges, legal fees, crew wages, repairs. Some of those may be treated as recoverable under the policy, and some may not. The line depends on the policy language and the legal interpretation of what counts as a covered loss versus an unrecoverable business expense. This is where marine insurance developed some of its most distinctive concepts, such as abandonment and constructive total loss. A ship might not be physically destroyed, yet the insured might reasonably treat it as lost because recovery is impossible, or because the cost of recovery and repair would exceed the value of what would be recovered. Marine insurance practice created a mechanism for this. The insured could abandon the subject matter to the insurer and claim as if for a total loss, in exchange for giving the insurer whatever rights remained, such as salvage or any later recovery. This device was not created to be clever. It was created because the sea produces situations where the physical facts and the economic facts diverge. A battered vessel half floating on a distant coast might be physically present but economically gone. Abandonment also forces paperwork to do a particular kind of work. It turns a dispute about the future into a decision in the present. Instead of waiting indefinitely to see whether a ship can be recovered, a system is created in which the insured can say, in effect, on reasonable grounds, this is a total loss, and the insurer must respond. But because that is a powerful tool, insurers have incentives to resist abandonment unless the facts clearly support it. That produces disputes, and those disputes produce further rules about notice, about what counts as reasonable, and about how values and repair costs are calculated. At the same time, many marine losses are not total. They are partial. Damaged cargo, damaged hull, broken masts, spoiled provisions, leakage, fire that is controlled. Partial losses are where the system's accounting becomes most intricate. If a ship throws cargo overboard to save the vessel, general average may apply. That means the sacrificed cargo owner may be entitled to contributions from other cargo owners and from the ship owner because all benefited from the sacrifice. Insurance intersects with this because a merchant might insure the cargo, and the insurer, after paying, may step into the merchant's rights to claim contributions from others. In practice, this means a single storm event can generate multiple layers of paperwork. Logs documenting the peril, surveys documenting damage, average adjusters calculating contributions, insurers paying claims, and then pursuing recoveries. Average adjusters and surveyors matter here not as colorful characters, but as functional specialists. Their job is to turn messy reality into numbers. How much was the cargo worth at the start? How much arrived? Was the damage caused by seawater, by inherent vice in the goods, by poor packing, by delay, by theft, by heat? How much of a repair was necessary to make the ship seaworthy again? and how much of the repair counts as betterment that should not be charged to the insurer. These questions do not have intuitive answers. They have procedural answers: inspection, valuation methods, customary rules, and when those fail, litigation. As the London market matured, the broker became another essential part of the mechanism. For ordinary people, the broker can be understood as a professional translator between the merchant's story and the underwriter's terms. The merchant knows the commercial objective: get the cargo to market. The underwriter knows the risk categories and the clauses. The broker packages the voyage as a risk submission, presents it to underwriters, negotiates terms, and then, when a loss happens, helps assemble and present the claim. This brokerage role becomes increasingly central as policies become more standardized, and as multiple underwriters share the same risk in proportions. This is also where the slip practice becomes important in the London market. In practical terms, a slip is a short document summarizing the key features of the risk to be underwritten: ship, voyage, coverage terms, and amount, circulated among underwriters who indicate their acceptance by signing for a share. The slip practice reflects the market's need for speed and modular participation. A full policy could be lengthy and standardized, but the slip allowed the deal to be assembled in pieces. Multiple underwriters could join the placement without each negotiating a bespoke full contract from scratch. The result is that, in a busy port economy, insurance becomes almost like a routine part of shipping administration. A cargo is assembled, a ship is chartered, a bill of lading is issued, a policy is placed through a broker. Credit may be arranged against the insured goods. The paperwork does not just record the trade, it makes the trade financeable. A lender is more willing to advance money if the collateral is insured. A merchant is more willing to commit to a cargo purchase if the voyage risk is bounded. A shipowner is more willing to accept a charter if the freight and hull exposures are managed. None of this eliminates fraud, and fraud is one of the reasons marine insurance developed strict doctrines and suspicious habits. Fraud can occur at many levels: overstating cargo value, insuring goods that were never shipped, arranging intentional losses, falsifying logs, conspiring with captains, or declaring a vessel lost when it is not. The market's defenses against this are partly legal and partly social. Legal defenses include strict disclosure rules, warranties, and the requirement of an insurable interest, meaning the insured must actually stand to suffer a loss from the casualty. Social defenses include reputation and exclusion. In a concentrated market, someone known for dishonest claims may find it difficult to obtain coverage or credit. The duty of disclosure, framed in later legal doctrine as utmost good faith, is best understood as a response to the information gap built into sea voyages. The underwriter does not sail with the ship. The underwriter must rely on what the insured and broker say, and on whatever outside intelligence the market can gather. If insured parties can selectively conceal crucial facts, such as known defects, political risks already developing, or the true condition of a vessel, then the premium becomes meaningless. The rule aims to keep the pricing process honest enough that the market can survive. Even with such rules, disagreements happen because many important facts are not clean. Consider the boundary between an external peril and negligence. Storms are external, but a ship's survival in a storm depends on preparation and conduct. An insurer might argue that a captain took an unreasonable risk by leaving port in a bad season, or that a ship was overloaded, or that maintenance was inadequate. The insured might respond that the storm was extraordinary, that the ship was properly handled, and that losses of this type are exactly what insurance is for. Courts and arbitration mechanisms became the arena where these boundary judgments were made, and over time those judgments shaped market practice. Now, to connect convoy planning more directly to insurance pricing, it helps to imagine how an underwriter might mentally sort voyages during a period of intense naval conflict. A merchant proposes a voyage through a sea where hostile cruisers operate. If the ship is sailing independently, the underwriter might assume a higher probability of capture and therefore demand a higher premium or refuse. If the ship is sailing in convoy with naval escort, the underwriter may consider the capture probability reduced and price accordingly. But convoy schedules are not fixed like modern timetables. They depend on naval resources and strategic priorities. That creates a second information problem. Not just is convoy available, but will the convoy actually sail? Will it reach the intended waters? And will it hold together? The underwriter's need for that information encourages a constant flow of maritime news. Reports of convoys forming, reports of escorts, reports of sightings and captures. In other words, insurance doesn't simply respond to information. It creates sustained demand for information. The more money depends on knowing what is happening at sea, the more institutions emerge to collect and circulate news. Over time, this produces a kind of feedback loop where shipping intelligence becomes more systematic because insurance makes it valuable, and insurance becomes more systematic because shipping intelligence becomes available. As insurance becomes more systematic, so does the idea of reinsurance, insurers themselves insuring their exposures with other insurers. In a world of large and correlated risks, reinsurance is another layer of diversification. An underwriter might accept a share of a voyage, but then lay off part of that share elsewhere. Or an insurer might buy protection against a concentration of risks in a particular route. This adds further paperwork, because the same underlying voyage can be represented in multiple contracts stacked on top of each other. Once you reach that stage, marine insurance begins to look like an information processing system as much as a financial one. It takes in descriptions of voyages, estimates of peril, and legal classifications of events. It outputs premiums, policy terms, and claim payments. Along the way, it generates disputes, which generate precedents, which generate standardized clauses, which generate new ways to submit risks and prove losses. The ocean remains unstable. The paperwork becomes stable. To see the system at its most operational, it helps to follow the life cycle of a claim in more detail, because that is where the categories are tested. A loss occurs. The insured must give notice to the insurer within whatever time is required. The insured gathers evidence, invoices showing value, bills of lading showing shipment, logs and reports showing what happened, surveys showing the condition of ship or cargo, correspondence from agents at intermediate ports, and any official documents such as protest statements made by the master, which historically served as formal declarations that damage occurred due to perils of the sea rather than negligence. If the loss is partial, the claim becomes an accounting problem. What proportion of the loss is recoverable under the policy? If the cargo is damaged but still saleable at a reduced value, the loss might be calculated as the difference between sound value and damaged value, subject to policy terms. If the ship is damaged, the claim may include repair costs, but not necessarily every associated cost. If the voyage required a port of refuge for repairs, there may be disputes about which expenses are sue and labor, expenses, costs incurred to prevent or minimize loss, and which are ordinary operational expenses. The very existence of sue and labor concepts shows how insurers wanted to encourage insured parties to take reasonable steps to reduce damage, not simply sit back and allow losses to grow. If the loss is total or treated as total through abandonment, another set of steps applies. notice of abandonment, acceptance or rejection by insurers, and then the subsequent handling of salvage rights. Salvage is not an afterthought. It is the practical endgame in many casualties. If something can be recovered from a wreck, or if a detained vessel can be released, that recovered value affects what ultimately counts as loss. The insurer, after paying, may have the right to pursue salvage or recovery. This is another way the paperwork makes peril manageable. It makes loss not a single moment, but a process that can include recovery and reallocation. All of these procedures become especially complex when the loss is not sinking but capture and detention. A ship might be held for a period and then condemned, or held and then released, or released with conditions. Cargo might be partially sold, confiscated, or returned. The chain of documents involved can include not only maritime commercial records, but also legal filings and judgments in the capturing power's prize courts. In such cases, the difference between a covered loss and an excluded one might come down to the legal characterization of the voyage. Was it lawful trade, or was it considered to violate blockade rules or contraband rules? Insurance therefore connects commercial paperwork to state legal systems in a direct way. It forces merchants to care deeply about how states define legality at sea, because legality becomes a variable in the probability and size of loss. What makes all of this comprehensible, even to people unfamiliar with maritime history, is the consistency of the underlying question. What exactly was promised? What exactly happened, and how do we prove it? Every part of the system is designed to answer those three questions with enough precision that money can move without collapsing into endless argument. In the background, the market also tries to prevent a certain kind of collapse. The collapse where too many insured parties are desperate to claim, and too many insurers are desperate not to pay, and trust evaporates. This is why reputation is so powerful in concentrated markets. If an underwriter gains a reputation for avoiding valid claims through technicalities, brokers may steer business elsewhere. If a merchant gains a reputation for dubious submissions and inflated claims, underwriters may refuse or charge punitive premiums. The paperwork is important, but the market's social structure decides how aggressively the paperwork is used. By the 19th century, as steam power begins to supplement and then transform parts of maritime navigation, and as global trade volumes grow, the categories of risk shift. Steam reduces dependence on wind, but introduces machinery risks. Iron and later steel hulls change collision dynamics and repair practices. Port infrastructure grows, and with it, new forms of cargo handling risk. Underwriters and policy forms adapt, but the logic remains. New technologies produce new failure modes, and insurance responds by rewriting clauses, building new inspection regimes, and generating new disputes that become the next generation of rules. All of this can feel far removed from pirates, but it is actually the same story. Pirates, privateers, and enemies are simply one set of perils that had to be written into a system capable of dealing with every peril. In the end, the insurance market's most important innovation was not a particular clause about pirates. It was the creation of a contract and information apparatus that could take any peril, whether natural or human, and decide how it would be priced before the voyage and argued about after the voyage. And once you see it that way, you can follow the system into one of its most revealing stress periods, the long era of late 18th and early 19th century warfare, when capture, blockade, convoy, and neutral trade disputes were not edge cases but central features of maritime commerce. This is the moment when merchants and underwriters are forced, day after day, to ask whether a voyage is even insurable on ordinary terms, and when the paperwork grows sharper and more conditional because the line between normal sea risk, and political seizure becomes the line between a tolerable premium and an unmanageable exposure. Wartime stretch is where marine insurance becomes easiest to see as a working machine, because it is forced to deal with repeated, legally complicated losses while trade continues. In peacetime, a market can tolerate ambiguities because the number of truly contested cases is smaller. In wartime, ambiguity becomes expensive. Merchants are still shipping because demand for goods does not stop. States still need supplies, and certain routes remain profitable even after premiums rise. But the nature of the risk changes from mostly physical hazards to hazards that depend on law, policy, and state power. That is precisely the kind of uncertainty insurance struggles with, and precisely the kind it tries to turn into clauses. In the late 18th and early 19th centuries, especially during the long sequence of conflicts associated with the French Revolutionary and Napoleonic Wars, the sea became a contested legal environment as much as a physical one. Britain, France, and other powers used blockades, seizures, and complex rules about neutral shipping. Privateers operated under commissions, and prize courts processed captured ships and cargoes. The result for merchants was that loss could happen without a ship sinking. A ship might be intercepted, carried into port, held while papers were examined, and then either released or condemned. Even when released, delay alone could be economically destructive for perishable cargoes or cargoes tied to tight market windows. And the costs of detention, legal fees, port charges, wages, provisions, accumulated while the final outcome remained uncertain. Insurance tried to map that mess into categories. The most basic move was to separate war perils from ordinary marine perils in a way that could be bought and sold. Underwriters wanted to know whether they were covering storms and navigation risks, or also covering capture, seizure, and detention. When capture risk was high, it could dominate the entire premium. If a policy bundled everything together, the price could become so high that ordinary shipping would struggle. If war risk could be priced separately, merchants could choose how much protection to buy, and underwriters could try to keep their exposures within tolerable limits. But separating perils did not eliminate disputes, because capture itself had subcategories that mattered. A key question was whether a taking was lawful under the relevant prize law. If it was lawful, the property might be condemned and become a total loss. If it was unlawful, the property might be restored. That seems like a clear distinction until you remember that the decision could take time, and that the decision depended on documents, ship's papers, manifests, invoices, bills of lading, letters of instruction, and sometimes correspondence that could be used to infer the true ownership and purpose of a voyage. This pushes the story back toward paperwork as a form of navigation. Captains and supercargoes did not just carry compasses and charts. They carried documentation that could decide whether their ship was treated as neutral or enemy, whether the cargo was contraband, and whether the voyage was framed as lawful commerce or as an attempt to evade blockade. In wartime seas, the right papers could be as important as the rigging. A merchant arranging a voyage had to think not only about the physical route, but about the documentary route. What would be shown if stopped? What would be written on the manifest? What names would appear on the bills of lading? How the cargo would be described? And whether the story those documents told would survive scrutiny in a prize court. Insurance responds to this by caring intensely about legality and disclosure. If a merchant intends to run a blockade, or to trade in a manner likely to be condemned, that is not merely adventurous. It is a material fact that changes the risk. Underwriters price on the assumption that the voyage is lawful within the prevailing rules, or at least within the limits of what they are willing to cover. If the voyage is effectively a bet against enforcement, the risk is higher and more correlated, and underwriters may refuse or demand a different premium. This is one of the ways insurance becomes a quiet regulator of behavior. It makes certain kinds of legally risky commerce harder to finance by making it harder to insure at an acceptable price. Convoys, again, become an insurance variable. It is not necessary to idealize convoy as protection. Convoys had their own vulnerabilities, and escorted groups could still be attacked or dispersed. But convoy alters probabilities. In a world where many capture events are opportunistic, escort presence changes the calculus. Underwriters respond by treating sailing with convoy as a risk-reducing factor, and in some contexts, by requiring it or rewarding it through pricing. This introduces another administrative dependency. Merchants become attentive to naval schedules and instructions, and their commercial planning becomes entangled with state decisions about escort allocation. The risk price is not merely a reflection of nature. It becomes a reflection of policy. The paperwork cycle tightens in wartime because the claims themselves become more frequent and more contentious. A storm loss is often argued in terms of physical evidence and nautical reasonableness. A capture loss is argued in terms of documents, legal classifications, and timelines. When a ship is captured, there may be two phases of uncertainty. First, uncertainty about whether it has been captured at all, because information travels slowly and ships can disappear for many reasons. Second, uncertainty about legal outcome, because condemnation or restoration depends on court processes. Insurance markets therefore have to decide how they treat a vessel that is missing and how they treat a vessel that is detained. This is where older maritime habits and newer insurance doctrine intersect. Merchant communities have long had ways of dealing with missing ships, including presumptions of loss after a certain period. Insurance systems adopt similar devices because without them, a missing ship could leave capital frozen indefinitely. But any fixed presumption creates incentives for opportunism and for dispute. Insured parties may want the presumption to trigger earlier so they can recover sooner, while insurers may want it later to reduce premature payouts and to preserve the possibility of recovery. The rules that emerge are procedural compromises. They are not perfect. They are designed to keep commerce moving. One of the most revealing features of marine insurance in this period is how often it becomes an argument about the boundary between total loss and partial loss. Capture can lead to total loss, but it can also lead to recovery after ransom or after legal restoration. In some regions and periods, ransom was a real and organized practice, and the question for insurance is whether ransom payments are recoverable and under what terms. The moment you allow recovery of ransom costs, you have to define what counts as reasonable, who is authorized to negotiate, and how to prevent perverse incentives. If you deny recovery, you may discourage ransom and encourage other strategies. Insurance does not decide such questions alone, but it becomes part of the economic environment that shapes decisions. Abandonment becomes particularly important in capture scenarios because the economic reality can become obvious before the legal reality is settled. If a ship is held in a hostile port and is likely to be condemned, the insured may want to abandon and claim a total loss rather than wait months or years for a prize court outcome. Insurers may resist if they believe recovery is likely, or if they want control over salvage and legal efforts. The paperwork around abandonment is therefore not just a technicality. It is a contested mechanism for deciding who bears the burden of waiting under uncertainty. All of this makes it tempting to think of the insurance market as a simple adversarial system. Insured parties want payment, Insurers want to avoid payment. In practice, it is more complicated because the market depends on repeat dealings. Merchants, brokers, and underwriters often operated in overlapping circles. A broker placing a risk today might be presenting a claim tomorrow and placing another risk next week. The broker's credibility matters because underwriters rely on the broker's submissions, and because brokers rely on underwriters' willingness to pay valid claims promptly. That mutual dependency creates a kind of discipline that is not always visible in legal texts, but is visible in market behavior. Disputes happen, but so does a great deal of routine settlement, because the cost of constant litigation is high for everyone. The London Markets Organization, with multiple underwriters subscribing to a single risk, adds another practical layer to claims handling. If 10 underwriters each took 10%, then a claim is not a single negotiation but potentially many. The market therefore has incentives to standardize claims practices and to rely on shared documentation so that decisions can be coordinated. This is one reason market associations and shared forms matter. They reduce transaction costs and prevent each loss from becoming a bespoke fight with every signer. At the same time, the market's obsession with documentation can create its own distortions. When paperwork becomes decisive, there is pressure to produce paperwork that looks right, sometimes beyond what reflects reality. Captains and agents may learn what insurers and courts expect to see in protests, surveys, and reports. This does not mean the system is inherently fraudulent. It means that any system that hinges on documents creates incentives to shape documents. The market responds with verification practices, surveyors, correspondence cross-checks, requirements for independent statements. But it never fully escapes the basic problem that the sea is distant and evidence is imperfect. As the 18th century turns into the 19th, two broader shifts matter. One is the expansion of global commodity flows and the increasing integration of shipping with industrial supply and consumer markets. The other is the gradual emergence of more formalized insurance companies alongside subscription markets and individual underwriting. The subscription model remains important, but corporate forms become more prominent in many places, partly because pooling capital in an incorporated entity can provide more stability and allow larger aggregate exposures. Corporate insurers also develop internal procedures, clerks, and standardized claims departments. That further intensifies the paperwork character of the system. The sea remains the same, the office grows. The story also becomes increasingly international. Marine insurance did not remain an English or Mediterranean phenomenon. Ports and commercial centers across Europe and beyond developed insurance practices suited to their legal traditions and commercial needs. Yet the core mechanics remain recognizable. Policies define perils and voyages. Premiums reflect judgments about probability and correlation, and claims depend on documentation and classification. Where legal systems differed, enforcement and dispute resolution differed, and that affected pricing. A market with fast and predictable dispute resolution can often operate with lower friction. A market where disputes are slow and unpredictable can push premiums higher or drive business toward places with more reliable enforcement. Now, to return to the central curiosity-driving idea, pirates as paperwork. The question is how piracy itself is transformed by insurance logic. One transformation is the obvious one. Piracy becomes quantifiable in market terms. Routes notorious for raiding attract higher premiums. Seasons or political moments associated with increased raiding attract higher premiums. Merchants respond by changing routes, changing sailing practices, traveling in groups, hiring guards in some contexts, or relying on state escorts when available. Insurance is not the only driver of those decisions, but it becomes a constant economic signal. A premium is a message about what the market believes the danger is worth. Another transformation is that piracy becomes a cause of institutional development. If a region is persistently threatened, merchants and states have incentives to create convoy systems, to station naval forces, to negotiate treaties, or to establish consular networks and legal agreements. Insurance markets react to those developments in pricing, and that reaction can reinforce them. If a treaty reduces rating and the market believes it, premiums fall and trade increases, which can in turn strengthen the economic importance of maintaining that security arrangement. If a treaty is unreliable, premiums may not fall much and trade may remain constrained. The premium becomes a kind of barometer of confidence, not just fear. This is also where the difference between physical security and legal security matters. A sea lane can be physically dangerous, yet legally straightforward. Storms, reefs, and known hazards. It can also be physically navigable, yet legally perilous. Contested neutrality rules, shifting blockade declarations, ambiguous categories of contraband. Insurance can price both, but legal peril is often harder because it depends on decisions made by states and courts, and those decisions can change abruptly. That makes war risk and seizure risk particularly volatile. In markets, volatility often produces either high prices or withdrawals of capacity. When insurers withdraw, trade may slow or require state intervention, such as state-backed insurance schemes or subsidies. In certain contexts, the specifics vary by time and place, but the structural issue is consistent. Some risks become so correlated and so politically contingent that private markets struggle to hold them alone. If the 18th and early 19th centuries show the system under wartime stress, the later 19th century shows it under technological and administrative acceleration. Steam, telegraphy, and more regular schedules alter information flow and therefore underwriting. Before fast communications, underwriters often learned of losses long after they occurred. With faster communication, information arrives sooner, and the market's response can be more immediate. That can reduce uncertainty in some cases, but it can also amplify market reactions, because news that would once have arrived gradually can arrive quickly and move premiums abruptly. Faster information does not always mean calmer markets. It means more responsive markets. Classification and inspection also become more systematic as shipbuilding changes. As ships become more complex and capital-intensive, the value at stake rises, and insurers have stronger incentives to demand standardized assessments. Classification societies and registries provide that. Their function is not to guarantee that a ship will not be lost. Their function is to produce a shared language for assessing condition and construction quality, so that the market can price consistently. Again, the paperwork is a substitute for personal familiarity and a way to scale trust. In this world, the underwriter's job increasingly resembles the management of a database, even before anyone uses that word. Underwriters rely on past loss experience, on route statistics, on ship class information, on the reputations of owners and masters, on political intelligence, and on market signals. The premium becomes a compressed summary of many judgments. If you want to know what a market thinks about piracy or war on a route, you can look at premiums, because premiums are where belief becomes money. Yet marine insurance is never only about pricing. It is also about how the system behaves after the fact. That is why disputes remain central. A market that prices risk efficiently but fails to pay claims reliably will lose business. A market that pays too readily without controls will attract adverse selection and fraud. The balance is delicate, and the balance is policed by documentation requirements, surveys, warranties, and doctrines of disclosure. This is also why the story cannot end with the idea that insurance simply tamed the sea. The sea was never tamed. What was tamed, to the extent it could be, was the financial consequence of loss for individual actors. Insurance makes it possible for a merchant to survive a shipwreck, but it does not prevent shipwreck. It makes it possible for lenders to finance voyages without requiring impossible collateral, but it does not guarantee repayment. It makes it possible for states and companies to plan supply chains with some confidence, but it does not eliminate disruption. It changes the shape of risk rather than erasing it. The most concrete way to see that is to look at the continuing role of catastrophic events. Storms that destroy multiple ships, wars that close whole regions, sudden policy shifts that cause widespread seizures. In those moments, insurance markets can become strained, premiums rise, capacity tightens, terms become stricter. Merchants adapt, sometimes by reducing voyages, sometimes by shifting routes, sometimes by seeking state protection or alternative financing. The system is dynamic because the world it operates in is dynamic. When piracy resurges in particular regions, as it has in different forms across different centuries, the same mechanics appear again. Underwriters ask what the threat is, how concentrated it is, whether it is deterred by escorts or security measures, what the loss experience shows, and how reliable the information is. The premium becomes the market's translation of those answers. The paperwork, policies, security requirements, reporting practices becomes the operational expression of those answers. The story repeats, not because history is circular, but because the underlying problem is structural. Commerce crosses spaces where force can interrupt it, and finance builds tools to survive that interruption. What the late 18th and early 19th century period shows, more than anything else, is that marine insurance is a method for turning a world of contested power into a world of negotiable costs. The ocean does not care about contracts, but merchants and underwriters do, and they build contracts that anticipate the ocean's indifference. Pirates and privateers do not care about policy language, but courts and insurers do, and they build systems that classify the outcomes of violence. In that sense, pirates as paperwork is not a clever phrase. It is a description of the conversion process that allowed maritime capitalism to operate in a world where the boundary between lawful force and unlawful force was often decided after the fact by whichever institutions had the power to write the record. As those wartime decades receded and the 19th century moved on, the machinery that had been improvised in moments of crisis hardened into routine. That hardening happened in two places at once. One was in market practice, where brokers, underwriters, surveyors, and adjusters converged on standard clauses and habitual procedures, because doing everything from scratch for every voyage was too slow and too expensive. The other was in law, where courts and then legislatures turned recurring arguments into settled rules. The key point is that neither of these processes replaced the sea with certainty. They replaced personal, case-by-case bargaining with standardized expectations about how uncertainty would be handled. General average is a clear example of that shift from custom to standardization. The underlying principle was ancient and widely recognized, but the practical question that kept returning was what, exactly, counted as a general average sacrifice or expenditure, and how, exactly, it should be adjusted among the parties. As shipping grew more international, the pressure for a uniform approach increased, because a casualty could involve shipowners, cargo owners and insurers based in different places, each with their own traditions. In 1890, rules known as the Antwerp Rules were agreed as an international set of guidelines for general average, and they were revised multiple times afterward. Their role was not to create general average from nothing, but to make the adjustments more predictable by narrowing the range of disputes about what qualifies and how calculations are made. Once those rules exist and are commonly incorporated into bills of lading and other contracts, the paperwork becomes not only a record but a coordination device. It tells everyone in advance which playbook will be used when the emergency happens. This same movement toward predictable playbooks is visible in the legal codification of marine insurance in the English tradition. By the early 20th century, the body of case law and market practice had become extensive enough that a statute could gather, define, and restate key principles in a single framework. The Marine Insurance Act 1906 did exactly that for the United Kingdom, codifying concepts such as insurable interest, indemnity, and the duty of utmost good faith, and setting out how warranties and other central mechanisms operate in marine insurance. The practical effect of that codification was not to eliminate argument, but to reduce the number of arguments that had to be reinvented from scratch. It made the rules legible in a way that merchants, brokers, and courts could share. The duty of utmost good faith is worth lingering on because it is one of the places where the moral language of the law is actually a technical response to a structural problem. Marine insurance is formed under conditions where the insured often knows more than the insurer about the ship, the cargo, the voyage plan, and sometimes the political circumstances. The law's demand for disclosure is not an ornament. It is a way to keep the market from being overwhelmed by adverse selection, where the highest risk voyages are disproportionately the ones seeking coverage at prices that assume average risk. When that happens, premiums rise, safer merchants leave the market, and the market can become unstable. The disclosure doctrine is a stabilizer, and it is enforced through remedies that are deliberately strong because weak remedies would not deter strategic concealment. Warranties operate in a similar stabilizing role, but through a different mechanism. The insurer is saying, in effect, I will price and accept this risk as long as certain conditions remain true. The insured is saying, I accept that those conditions are part of the bargain. The strictness of marine warranties can look unforgiving, but it reflects the underwriter's dependence on assumptions that cannot be policed continuously once the ship sails. The sea makes continuous oversight impossible, so the market substitutes contractual strictness. As the legal and procedural framework became clearer, the insurance market also split into more specialized compartments. The older story often focuses on hull and cargo, ship and goods, but maritime commerce generates many other exposures. Collisions, injuries, pollution, and cargo liability do not fit neatly into the traditional hull and cargo model. In the 19th century, shipowners increasingly faced liabilities that ordinary marine policies either excluded or covered only up to limited amounts. Underwriters were reluctant to provide open-ended liability coverage on the same terms as property coverage, because liability losses could be unpredictable and difficult to cap. The shipowner's response was to pool their own resources through mutual associations. By the mid-19th century, these protection associations began to form, and they evolved into what later became known as protection and indemnity clubs, or P&I clubs. The significance of P&I clubs for the pirates as paperwork story is not that they are about pirates specifically, but that they show the same logic repeating in a new category of peril. When a risk is hard to price and hard to limit, private underwriters may either charge very high premiums or refuse it. Mutuals can take a different approach. They can spread the risk among members, call for additional contributions if needed, and develop shared loss prevention rules and claims handling practices. That mutual structure creates its own paperwork, membership rules, calls, claims procedures, and technical guidance. It is another way that maritime danger creates institutions whose main activity is turning events into administrable categories. By the late 19th and early 20th centuries, this landscape had become dense. Hull insurance, cargo insurance, general average adjustments under increasingly standardized rules, and shipowner liabilities handled by mutual clubs. Above these layers sat reinsurance, spreading exposures across wider networks so that no single underwriter or club bore the full impact of clustered losses. The system becomes less like a single contract and more like a stacked architecture of contracts. A ship sailing across an ocean might have its hull insured by a subscription market, its cargo insured by separate policies held by different cargo owners, its liabilities covered by a P&I club, and the insurers and clubs themselves protected by reinsurance treaties. The sea hazard is one, the contract stack is many. At the same time, the information environment continued to change. Telegraphy and more regularized shipping schedules increased the speed and volume of maritime intelligence. Faster news tightened the gap between event and market reaction. Underwriters could change pricing more quickly in response to losses, war scares, or seasonal dangers. Merchants could seek coverage with more immediate knowledge of what was happening along routes, but they also faced markets that could harden instantly when a cluster of captures or storms was reported. In earlier centuries, the slowness of communication created a long haze of uncertainty. Faster communication reduced that haze, but it replaced it with rapid shifts in confidence. The premium becomes not merely a long-run average but a real-time signal. This matters because piracy and maritime violence are not evenly distributed. They cluster in certain waters and certain moments. When a cluster emerges, markets react in ways that can be traced through the mechanics. Additional premiums for particular routes, new requirements for reporting, conditions about escort, or explicit clauses dealing with warlike operations. Even when a contract does not mention piracy in a modern, narrow sense, it often contains broader categories: violent taking, seizure, restraint, that can be interpreted to include it depending on how the event is framed. The market's need to frame events consistently becomes a constant pressure on language. Language itself, over time, becomes more modular and more standardized. Instead of each policy containing long lists of perils written out anew, standardized clauses circulate and are attached to policies as needed. Cargo cover in the 20th century, for example, increasingly relied on standardized institute clauses that define coverage categories, exclusions, and conditions in a form recognized across much of international trade. By the late 20th century, widely used versions of these clauses were introduced to bring consistency to global cargo insurance practice, and later revisions updated the language again. The reason for this standardization is not only convenience. It is the need for predictable interpretation across jurisdictions and across large volumes of shipments. When cargo moves in containers and supply chains depend on routine shipments rather than occasional ventures, insurance cannot function as a bespoke artisan product. It has to function as a repeatable procedure. That shift toward repeatability also changes how people experience insurance. In earlier centuries, merchants might have seen insurance as a negotiated arrangement tied to a particular ship and voyage. Over time, many shippers come to see insurance as an embedded feature of trade, often arranged through brokers or built into contractual terms of sale and carriage. The visible act is no longer a meeting in a coffee house. It is an entry in a system, a certificate, a clause in a contract of sale, a declaration of value, and a set of conditions that are triggered if something goes wrong. The drama of underwriting does not disappear, but for many participants, it becomes bureaucratic rather than conversational. The two world wars provide another set of stress tests that show how marine insurance handles extreme political correlation. In those wars, the risks of loss were not limited to storms and occasional captures. Submarine warfare, mines, aerial attack, convoy systems on a massive scale, and state controls over shipping combined to create an environment where losses could be frequent and widely distributed. Ordinary market mechanisms struggled with the scale of correlated war risk, and states played a larger role in managing or backstopping coverage in different ways depending on the country and the period. Even without tracing every national program in detail, the structural point remains. When the risk becomes so correlated that diversification fails, purely private insurance markets tend to tighten sharply, and the handling of risk becomes entangled with state policy. Those war periods also sharpened the separation between marine and war categories, because the distinction carried operational consequences. A cargo owner and a ship owner needed to know whether their loss would be treated as a war risk loss or an ordinary marine loss, because different coverages, premiums, and claims procedures could apply. The paperwork is again forced to become explicit, because ambiguity becomes too costly when losses are frequent. Clauses proliferate, exclusions are clarified, and specialized war risk insurance becomes more clearly delineated. After the mid-20th century, shipping itself changes in ways that reshape the risk landscape. Mechanization and containerization alter cargo handling. Ports become larger, faster, and more standardized, but they also concentrate value. A single container ship can carry enormous aggregate cargo values, and disruptions can ripple through supply chains. The risks also shift toward complex casualty scenarios, collisions in busy waterways, groundings with environmental consequences, fires involving mixed hazardous cargoes, and logistics disruptions that create large accumulations of goods in terminals and warehouses. The insurance response is not a single invention, but a continued refinement of the contract stack. Clearer cargo clauses, more specialized liability cover, broader use of reinsurance, and a stronger emphasis on risk management and loss prevention. In this environment, piracy becomes one peril among many, but it remains a useful lens because it is a kind of violence that is both ancient and adaptable. In different eras, it has taken different organizational forms, from small raiding parties to state-adjacent privateers to criminal networks exploiting weak maritime enforcement. Insurance markets respond not with moral judgment, but with categorization and pricing. When a region becomes associated with elevated attack risk, underwriters may impose additional premiums for voyages through that region, require certain security measures, or restrict coverage unless certain conditions are met. These measures are not necessarily universal and can vary by insurer and market, but the mechanism is consistent. The market tries to convert an unstable threat environment into a set of terms that can be administered. The administrative character becomes especially visible in the way security measures are translated into insurable conditions. A shipowner might be asked to demonstrate compliance with route guidance, reporting requirements, watchkeeping practices, physical hardening measures, or the use of contracted security in certain contexts. Each of these becomes a documentary item. Certificates, logs, contracts, declarations, and incident reports. After an attack, The claim process will often hinge on whether those conditions were met and whether the event fits within the policy's definitions of covered perils versus excluded acts. The event itself can be chaotic and violent, but the settlement process is an exercise in classification. That classification has limits. A core limitation of marine insurance across centuries is that it pays money. It does not restore time. In modern supply chains, delay can be as damaging as physical loss, yet many standard cargo policies focus on physical loss or damage and exclude pure delay unless it results from a covered physical event and specific extensions apply. This creates a persistent mismatch between commercial pain and insurable categories. Merchants feel the loss in missed markets and broken contracts. Insurers look for physical damage, documented causation, and coverage triggers. This mismatch is not a sign of failure so much as a boundary. Insurance cannot easily price every business consequence of uncertainty without becoming either prohibitively expensive or structurally unstable. So it chooses categories it can administer and leaves other consequences to be managed by different tools. Inventory buffers, diversified routing, contractual penalties, and sometimes state intervention. If you step back from the details, the long arc becomes clearer. Marine insurance grows wherever three conditions coincide: valuable cargoes, long voyages, and imperfect control. The sea guarantees imperfect control. Valuable cargoes and long voyages expand with trade. Once the problem exists at scale, insurance evolves as an information and enforcement system. It needs shipping intelligence before the voyage, and it needs documentation after the voyage. It needs rules that reduce strategic concealment and fraud, and it needs procedures that can settle disputes without paralyzing commerce. Over centuries, that produces a world in which a pirate attack is not only an act of violence, it is also a claim file, a clause interpretation, a survey report, and a line in a ledger that feeds back into next season's premiums. This feedback is one of the most underappreciated features of the system. Premiums are not only prices, they are messages. They tell shipowners and merchants what the market believes about safety, political stability, and the effectiveness of protective measures. When premiums rise sharply for a corridor, they can discourage voyages or push operators toward convoys, alternative routes, or additional security. When premiums fall, they can encourage traffic to return. In that sense, the insurance market becomes part of the governance of trade, even though it is not a government. It allocates costs in a way that shapes behavior, but the market is always working with imperfect knowledge. Underwriters estimate probabilities based on past experience, reports, and classification tools, but rare events and changing tactics can break those estimates. When tactics change, the paperwork changes. New clauses appear. Exclusions are refined. Security requirements are rewritten. This constant rewriting is not evidence of instability alone. It is evidence that the sea and the people who operate on it do not stand still. Insurance follows by continuously rebuilding its categories. In the end, the phrase, "how maritime insurance created a price for risk," can be taken literally. The market did not discover a single true price that was always correct. It created a mechanism for producing prices that could be negotiated and revised as information changed. That mechanism depends on paperwork so deeply that the paperwork becomes the real infrastructure. The ships are the visible infrastructure. The ports are the physical infrastructure. But the contracts, clauses, logs, surveys, adjustments, and legal doctrines are the infrastructure that allows capital to move in spite of everything the sea can do.